China's leader Xi Jinping has been making big moves lately, especially when it comes to China's stock market. If you've been following the news, you might have noticed that he's been talking about building a high quality market, one that matches China's status as a global economic power. But what does that actually mean, and why now? Well, for a long time, China's stock market wasn't exactly a priority for its leaders. Sure, the economy has been booming since the late 70s, growing at an average of 9% every year. But the stock market? Not so much. In fact, if you look at the numbers, the MSCI China A Onshore Index, which tracks the performance of Chinese stocks, has only grown by around 4.4% annually. That's a huge gap between China's overall economic growth and the returns investors have been seeing. So, why the sudden focus on building up the stock market? Xi's shift could be part of a broader trend. We've seen similar moves in places like Japan and South Korea, where governments have also been pushing for more shareholder value. And now it looks like China's jumping on the bandwagon. In September, China rolled out a couple of new initiatives aimed at boosting stock prices. One of the biggest moves was a plan to offer loans to companies at super low interest rates, just 2.25%, to encourage share buybacks. The idea is to pump more money into the market, and Morgan Stanley estimates that these schemes could inject about 800 billion yuan, or around $112 billion, into Chinese stocks. And it seems to be working, at least in the short term. The benchmark CSI 300 index, which tracks Chinese stocks, jumped over 20% in a month after the news broke. But as with anything involving the stock market, people are wondering if this is just setting the stage for another bubble. Here's where things get interesting. Xi's goal isn't just about pumping up stocks to create a quick rally. There's a deeper plan in play. By boosting the stock market, China can give its people more reliable places to invest their money. Right now, Chinese households only put about 10% of their assets into stocks. Most of their money is in property. But with real estate prices crashing and government bond yields falling, stocks are starting to look more attractive. And it's not just individual investors who would benefit. China's state-owned enterprises, or SOEs, make up almost half of the country's stock market value. By increasing dividends and pushing these companies to give more back to shareholders, Xi's plan could actually help local governments who are feeling the pinch from the property market downturn. Goldman Sachs estimates that even a 10% increase in SOE dividend payouts could channel an extra 230 billion yuan to the government. That's a lot of cash. But as promising as all this sounds, there are still some big challenges. China's stock market has a history of wild swings, partly because of political interference. Back in 2015, for example, a huge stock market surge was followed by a massive crash when regulators cracked down on margin trading. And while the government wants to boost shareholder value, it's also known for stepping in to control the market when things get rocky. That kind of unpredictability makes institutional investors nervous, which is why only 11% of China's stock market is held by big institutions. So, is Xi's plan to build a strong, reliable stock market going to work? It's hard to say. On one hand, China's companies are in a good position to pay out more to shareholders, and boosting the stock market could help support innovation and give startups a better way to raise money. But on the other hand, the level of government control over the market could make it tough to attract long-term investors. At the end of the day, Xi's trying to balance a lot of competing priorities. He wants a stock market that boosts the economy, but he also wants to maintain control over what companies build, how they grow, and how much they spend. It's a tricky balance to strike. So, while the stock market is cheap right now and everyone wants higher returns, building a truly strong market may take a lot more than just pumping in cash. Only time will tell if China can truly build a market that stands the test of time. For now, all eyes are on Xi's next move.